Welcome to episode 15 of the Tax Smart Daily, a daily video series for real estate investors to help you save money and keep you out of trouble. I'm Brandon Holm. Before we get started, I didn't record daily videos last week because we were training 3 new tax managers here at our firm. So I do apologize, but I'm going to give you 2 videos today, Sunday, to make up for it. So hopefully that counts for something. But before we do get started, check out the links in the description of this YouTube video to join our Facebook group, the Tax Smart newsletter. And leave a comment if anything resonates with you or if you have any questions from anything that I say in this video. Today's topic is going to be about the Biden tax proposal and what real estate investors need to keep tabs on. Now, it's just a proposal. We haven't even entered, well, that's not totally true. We are entering negotiations in Congress today, or well, not today, but as we speak, there are negotiations going on. So we will know more over the coming weeks and months. And if you need more up-to-date information on where the proposals are and where the negotiations are, join the Tax Smart newsletter. Again, it's a weekly newsletter that we send out to all real estate investors, and the link to that is in the description to this video. The Biden tax proposal. Let me go over what has been proposed and what's being negotiated. Now, proposal, because it is a proposal, after negotiations, it's going to look really different. So don't get all spun up just because you hear something that might be detrimental to you in this video. It is all subject to change. But let's talk about this. So the very first one is the top marginal income tax rate is going to go from 37% to 39.6% for taxpayers with taxable income over $509,000 for married filing jointly, and then over $452K if you're single. So 37 to 39.6% if you're at 509 if you're married, and 452 if you're single. The big one that everybody's talking about is taxing capital gains of high income individuals when your adjusted gross income exceeds $1 million, and that capital gain rate will be at 37%. So if you earn a $1 million W-2 job and you've got a $1 million adjusted gross income, and then you sell some Apple stock or you sell some real estate, instead of paying a 20% long-term capital gain tax, you're going to pay a 37% long-term capital gain tax. And that's before we factor in the 3.8% net investment income tax that is assessed as well. So you could really be paying about 41% on the long-term capital gains that you have if your adjusted gross income is over $1 million. Along those lines, the other big one that everybody's talking about is eliminating that stepped up basis for, again, if you have gain over $1 million. So right now I get a stepped up basis in any asset that I inherit from my parents. At least that's the way that the code is written today. And what that means is if my parents bought an asset for $100,000 and now it's worth $500,000, they pass away, they hand it to me, I get a stepped up basis to $500,000, today's fair market value. And what that means is I can turn around and sell the asset for $500,000 and not pay tax because my basis is $500,000. It was stepped up to fair market value. So I sell it for $500, my basis is $500, my tax is $0. But they're going to make some changes here, and they're going to make these changes to eliminate that stepped up basis. So now instead of having a $500,000 basis, I'm going to inherit my parents' basis. So I'll have a $100,000 basis. If they depreciated the property, it's going to be even less because it's going to be the adjusted basis. But I'll have a $100,000 basis. I go sell it for $500,000. Now I've got a $400,000 capital gain. That one's going to be a large negotiation, or there's going to be a lot of negotiating there because there's small businesses, there's farms that Congress wants to protect, doesn't want to go and penalize, and wants to make sure that they stay in the family. So it'll be interesting to see kind of how that one plays out. But keep an eye on that stepped up basis. That is going to be tied to the long-term capital gain of that long-term capital gain increase going to 37% if your adjusted gross income is more than $1 million, because if they didn't tie this stepped up basis to that, or if it didn't mirror that, then let's say that my AGI is $1 million and I have the choice to either sell these assets or just hold them until I die and eliminate the tax. I'm just going to hold them till I die and eliminate the tax because of the stepped up basis rules. So now they have to tie the stepped up basis rules to this long-term capital gain tax to ensure that I don't hold the assets until I die. Because if I can't get a stepped up basis, then now I've got a decision to make. Should I go ahead and sell the asset, or should I just keep it until I die and my heirs will not get a stepped up basis because of how much money I earn? So keep an eye on those two. Those will be interesting to kind of see how they play out. The 1031 exchanges are proposed to be limited to the first $500,000, or is per taxpayer. So it's $1 million if you're filing joint. $1 million a gain that you're allowed to roll over if you're a married filing joint every year. This is an annual an annual limitation. Right now, you can exchange any gain for any amount, and as long as it follows the 1031 rules. But the proposal is to limit it to $500,000 per taxpayer. So if you're single, you've got a $500,000 gain limitation that you can roll over, that you can 1031 every year. And if you're married filing joint, it's a $1 million gain that you can 1031 every year. And let's see, I'm just looking at my cheat sheet real quick to see if I'm missing any other major ones. And looks like maybe not. There's some carried interest stuff. There's some child tax care credit stuff, but it's really the main ones are the income taxes going up, the long-term capital gain taxes going up, and then the stepped-up basis. The stepped-up basis being reduced or eliminated depending on how much money you earn, and then that 1031 exchange limitation that I just talked about. Now, on the long-term capital gains, it is going to be. So the Treasury published a Green Book report, and what that is just it's basically like, here's how these different proposals would impact us over the next decade from a budgetary standpoint. And in their Green Book report for the long-term capital gain rate increase, they used the April date. I don't know the April date off the top of my head, but the April date where Biden basically publicly said, this is what I'm going to propose for long-term capital gain rates. So it is a retroactive tax. Now, why would they do that? Well, if they come out and they say, hey, starting December 31st or January 1st, 2022, this new long-term capital gain tax is in effect, what is everybody going to do? They're going to dump their assets in December to avoid that tax, and that's going to affect financial markets, and they don't want to do that. So they're going to say it's retroactive to the April date. That's what they assumed. That's not set in stone. Again, everything still has to go through Congress, has to be negotiated, has to be formally proposed. We're not even there yet, but that is kind of what we're expecting. So keep that in mind if you're making any sort of major changes. There's a lot of other stuff in here, especially as it pertains to the American Jobs Plan, and I'm not going to go over those right now, but I think that those are what I just discussed. Those 4 key things that you need to know are the income tax rates increasing, the long-term capital gain tax rates increasing. That can be really painful for real estate investors, so we'll do a lot of tax planning around that. The stepped-up basis potentially being eliminated based on income thresholds, and then that 1031 exchange limitation coming into effect. I hope that this is helpful. If you have any questions or comments, drop them in the comment section below. Timestamp it if you can. That'll help me just kind of like know what part of the video you're referencing. And these are your comments are my oxygen. I really love interacting with the community. So please do drop me a line below and join all of our various communities. Follow us online. Click all those links below this video. We'd really love to have you as part of our overall network. Thanks so much.